what was fascinating is the more I let the algo make decisions, first of all, the hardest part is just not interfering, right? So I've learned, like, because when people are saying, oh, look, it's within 2 pips of my take profit. I got to take my take profit. I got to take my profit. No, let it go. Let it go. Because once you sacrifice your take profits, you're sacrificing your risk reward ratios, and then everything goes askew. So letting it go, and then studying, well, where is it performing, where is it not performing, and then managing it has really helped me a lot. It's helped me to basically move myself out of the tick by tick, let me watch every single movement in a currency pair, to a much bigger bird's eye view of what's really happening, what's really leading to success or failure on a bigger picture, and made me a better manager. You go from being, I guess, when you're trading systems, you go from being a worker, which is what you are. You're kind of like, a production line worker, day trading all day long, making little widgets, pip widgets, to more of a manager, to more of a CEO, where the computer is kind of doing the work, and you're trying to figure out, well, how can I deploy my resources better? So it's, it is a higher level point of view. It really reduces a huge amount of stress. You're not sitting there going, God damn it, I can't believe I missed this trade. I can't believe I missed this trade. It was funny. Dollar CAD we just trading. There was such a fast moving dollar CAD. Just, before I talked to you, I'm like, oh man, I can't believe we missed this trade. And then I look and my algo took the trade, and like I didn't even notice my algo took the trade, made the trade, bang, and I'm like, oh great, okay, I'm done. I'm done. I'm out. I'm like, thank you, my worker bee. And that happens. It used to happen to me all the time, where you snooze, you lose. I go get a cup of coffee. I'm like, what the hell happened? We moved 100 points. I should have been in this trade. That's, I think, an experience of anybody who trades any asset on a point-and-click basis. It's impossible. But if you have a rules-based system that's kind of helping you, you avoid a lot of those problems. And regret is just a horrible thing, right? So my process is actually, let's create something that makes modest amount of sense. Let's trade it live. I always trade it live in live markets, because the other thing is, backtests always lie. And let me explain to you what I mean by they lie. They lie about where the prices are, like where the execution is possible. You think you could have gotten like a end of candle perfect entry yesterday in dollar yen, at whatever the backtest told you? It would have been 200 pips. So backtests always lie. So I always like to trade it in real market conditions, but with small amount of money. I'm always trading, small amounts of money. Let's put the little reconnaissance soldiers out there. See how well it trades. You're going to learn so much more. All your assumptions are going to be completely upturned once the market goes live. You begin to understand where's the volatility envelope. What currency pairs are actually responsive to your ideas, which are not. And that's really where a lot of the true work goes. All my work is in front testing, not even front testing, but front trading. I don't believe in the word testing. I believe in the word trading. So it's experience-based. All of my strategies are experience-based, and that's how, and then out of experience, you refine the rules, increase size, and create something that's tangible. That's my personal process of how I do it. The rule of thumb is you got to have at least, if you're day trading, you got to have about 100 trades just to have an idea of what the hell you're doing. Whatever your assumptions are. If you don't have 100 trades, it's not even a legitimate sample size. So it takes a couple of months to babysit a strategy into a decent idea. And remember, the whole point is it's an evolving organism. So the 3 myths I hate is positive risk reward ratio, right? Back testing is a must. And the other big myth I hate is set it and forget it. If you're a systems trader, it's a set it and forget it. I don't do anything. Nonsense. You do a ton. Ask yourself a question: what does it mean when it's not working? Right? Like the people go, you're losing money. That's so it's not. I'm losing money. It's not working. No, that's not the same thing. Losing money and it not working is not the same thing. And that's where I think a lot of people make the mistake. That's a very, very common, I think, rookie retail mistake. Understand what's going on. Maybe it's not working because the regime has completely changed. Like, what is the algo supposed to do? When is it supposed to be working, right? And also, I think a lot of times people have to be much more nuanced about what does it mean to be working. Like, for example, my algo doesn't work very well on dollar Swiss, right? But it works beautifully on euro dollar. Why? Well, because the volatility signature of the two pairs is quite different, and also liquidity characteristics are completely different. So just because it's not working on one thing doesn't mean it's a not successful algo. What your job is to find out where it is working, right? I guess that's kind of the key thing. My constant process is to figure out as many possible instruments on which this is working as much as possible. That's what I'm doing constantly. I'm searching, and then when you have that kind of attitude, it makes it a lot easier because you're not as you're not as deterministic. You're not like, forget it. I'm leaving it, and I'm never going to trade it again. And then all the guys in my room who are much more intelligent and much more patient than I am, like keep on trading it and then come back to me like 6 months later, hey, you know what? I made 2,000 pips from that algo that you gave me. And I'm like, what? Are you kidding me? Are you kidding me? And that was, that was kind of an eye-opening lesson to me that it's not the strategy, it's you. It's like, it's not you, it's me. That every trader should always look at themselves as the point of failure, not at their strategy, because usually that's always the much truthful point of view. You have to be kind of much more honest with what's going on over there. I absolutely think if you're starting out, it's really, especially if you're starting in FX, it's really, really important to learn the basics. Now, here's the thing. Everybody, I think, gets very scared because they think algos, they think coding, they think, oh my God, I got to be a programmer. I'm not smart enough to be a programmer. I haven't coded since like college. You don't have to do any of those things. You do not have to do any of those things. What you need to do, can you use an app? If you use an app on your iPhone or on your Android, you can pretty much trade algorithmically because so much stuff is already pre-written for you. But what you need to do is just like, you learn Microsoft Windows, you need to learn these programs. I actually created lots of free educational courses for people to, how do I install it? How do I use it? How do I press this button? What does this button do? How do I put on a chart? All those kind of things. It's really, I think, fundamental for anybody who wants to start trading to learn the software and become a proficient user of the software. Once you become a proficient user of the software, just by their very definition, your trading will improve incredibly because your execution will be on target, your sizing will be proper, your analysis will be much better because all of those things will be done by the machine, not by you.
I've always been, intrigued with software, and so I built a couple prototypes myself. And so think of it like I had a database that you can go for $600-700. You can go buy a database of all the market end of day prices. So I use something called eoddata.com, and you can go there and download the previous 20 years worth of market data. And it's basically just end of day. So you have things like the ticker symbol, the volume, the open, high, low, close, and a date. So all the data that we use now and all the data that I use for my prototype went back to January 1st, 1997. So at the time, it was roughly 21 years now worth of market data. And so I was intrigued by marrying the two things that the thing that I'm most experienced with, which is software, and trading, the thing I love, trying to marry the two together. And so generating buy and sell signals is fairly easy. You can look at certain patterns. You can kind of loop through all the data, look for stocks between $5 and up with minimal volume. You have all that data to kind of write scripts and look through. So that was kind of the easy part. The hard part was, how do you automate these orders? Like how do you send, like you and I know, you create an order, it may or may not get filled, it may be partially filled. How do you automate all that? And so I kind of went through all that. That's the process that I've gone through, but I can dig into deeper if you'd like as well. So one of the things we do is we have a specific amount of things we need to run it through. So we have like a checklist. So the first thing we need to do is run it through a back test. So our back tests are anywhere up to 21 years worth of data. And all of our trades are end of day. We're not currently doing intraday trades. We use everything that we do, buy and sell signals right now, is based on end of day data. So it's kind of essentially swing trading. We're not really day trading. That might be a future phase that we're looking at. But if your script is intraday, you need to have some kind of way to, MetaTrader 4 has some of this built in. You need a way to kind of loop over some previous time frame, whether it's 5 weeks, 5 months, 5 years, 10 years, X number of time frame. The other thing that we can do, and I don't know that MetaTrader MetaTrader does offer like a demo account. So you have to have some kind of, you run it through a backtest, but you also have to have some kind of way to test it in current market conditions. So even though we trade stocks, options, and ETFs, we let all of our algorithms run in a live current market environment. We call it simul-testing. So it's simulating what would happen in real time, even though the stock market took a little brief panic, I guess off and on the past 2 weeks. We're able to see how our algorithms would perform in that behavior before we put live capital to it. So that's one of the other things we do. So we spend a lot of time writing strategies and back testing them, and that's a back and forth, on and on, over and over and over. It's tempting to curve fit it so the back tests look good. In real life, it'll fall on it. The strategies fall on their face. So typically what we'll do is we do like a walk forward kind of model where we might run a single year of back tests. If we'll just say trend following, right? So we're looking for stocks in uptrend, some kind of a X% pullback, and then we play the break higher. So for us, what we would do is we would do 1 year at a time to make sure it still outpaces its benchmark. Now, not every year does it outpace the benchmark, but if you're looking at a group of 3, 4, 5 years, it certainly needs to. And so what we're looking for, our internal systems that we had built specifically for us, it'll actually graph the equity curve. So if you can imagine a graph where our strategy looks like this, on a gross level, maybe a little lower on a net level minus our fees, and then what the S&P 500 would do. And so part of what we would do is we'd look at it do a 1 year at a time kind of walk through. So imagine instead of doing one back test over 20 years, let's look at 20 back tests over 1 year each, kind of walking forward all through all the different years to see how it will perform in all different market conditions. The risk can work in your favor and it can work against you. So if I was to look at my previous, last year, just manually, I was up 35% in my account. We have a decent account. If I was to look at all the trades I took, a lot of what I took happened. There's gap ups in the market, certainly slightly different than Forex where you're trading around the clock. But there's a lot of gap ups, there's gap downs where a company might announce their earnings and things gap up or down depending on whether it was favorable or unfavorable. And so, yes, there's risk, but that's a two-edged sword. It can work in your favor and it can work against you. One of the reasons I stopped day trading and kind of went to swing trading was I do consulting and some other investing, and so I didn't like to have to babysit the trades. Keep moving up the stop as it goes in your favor, and every little tick against you, your heart's racing, and yes, you might have stops predefined, but when you're trading decent size, in Forex, any little pip move against you can really add up quickly. So I personally preferred the swing trading because I don't have to babysit it. I had a larger account, larger capital account to deploy, and I like my free time. Just to be clear, we're not trading a single strategy. We're trading, kind of think of it like a portfolio of strategies, and they're enabled, disabled at different times based on the strategic market conditions. So things that kind of go dormant, we manually review those. Maybe we need to update the model. Maybe we didn't run enough tests. Maybe it's just a fluke. So there's a whole series of things we need to do. Maybe when we ran the back test, is one of the things we've learned. When you run a back test, you got to make sure your data is correct. So we found inconsistencies in our data when we ran the original back test, right? So if you think about it, things like your data providers, who are you getting data from? So we use a bunch of different sources, but if you think about making buying and selling decisions based on your data, and what happens if your data is wrong? What happens if there's duplicates? What happens if there's data missing? All of that messes up all of your trading and all the models that you build because it's not an expected outcome. And so we always have random ideas. So I was reading an investing book the other day, and they were talking about certain things, certain way of like mean reversion, and I thought, that'd be interesting. So the ideas that we generate come from listening to podcasts, from reading books. I read quite a bit of content on Twitter. I kind of stay away from stock twits. That's just random random craziness. And so there's different sources that we use to generate ideas. A lot of podcasts just thinking, oh, well, that's interesting. I never really thought about that. Then we get to work trying to identify the data providers, write the strategies. And then sometimes a strategy, we just aren't able to get it to work. So that's fine. We might spend 30, 40, 50 hours on a strategy and we aren't able to get it to outrun our benchmarks, and that's fine too. We don't feel like that's a wasted effort because we're not putting those strategies live and losing capital, right? So I'd rather put the front end work in to get an idea of how well it should operate before going live with real capital. Each strategy has a predefined maximum number of open positions, and if you think about it, when you're building a strategy, we try to narrow the scope of what we're trying to look at. So if let's say that we want to look at any stocks or ETFs that are on the U.S. markets that are anywhere from $5 to $200. That greatly reduces the scope of maybe 8,300 to down to maybe 2,000 stocks. And so part of the definition there is how many open trades are allowed at any one time using a single strategy. And so it's typically around 8 to 10 open trades. It varies a little bit. But part of what we do is we have these variables, like the maximum number of open trades. We have those kind of exported, and the variables are kind of like kept on the side. And then every month we re-optimize what those variables are for the strategies as well. So we do think of it like a manual kind of thing. Obviously, if your account is 100% deployed and you're maxed out on your margin, then obviously that would you wouldn't be able to add any more positions. But we do look at how much we're up for a month or a quarter to know whether or not we want to be a little bit more aggressive than normal.